China is on the brink of economic collapse, and there's only one man to blame: President Xi Jinping. It may not look like it on the surface. In January 2024, official data out of Beijing showed that China's economy grew by 5.2% in 2023, surpassing the 5% target that Xi had set for the country at the beginning of the year. That's almost double the US growth, which Bloomberg says hit around 2.7%. So it seems all rosy in China, right? Not so fast. Lurking beneath the shiny surface of China's economic apple is a core that is slowly rotting away, and making its way through that core is a devastating worm, Xi himself, who threatens to leave China's economy in turmoil in the coming years. The question is simple: why? Why is Xi the reason for China's economic woes? After all, isn't he the great savior of the country? The man who's pushed China's military through rapid modernization efforts to the point where it's now one of the world's strongest nations? How could he be killing the country's economy? It starts with a couple of words: top-down control. Let's start with that announcement of 5.2% growth for 2023. Official sources in Beijing will tout that as a major success for the country, especially after a fairly lackluster 2022. Xi Jinping could hang his hat on the fact that Chinese growth has outstripped America's, perhaps giving himself a nice little ego boost in the process. But what he might not tell you, and what certainly isn't mentioned in China's official figures, is that Beijing invests about 40% of its gross domestic product, or GDP, every year. That's twice as much as the United States, with such heavy investment even leading to economists saying that the supposedly impressive 5.2% growth rate is actually a disappointing figure when you dig deeper into it. So 5.2% is less great of an achievement for Xi, and more a little ego boost that hides what's really going on. And that's where the concept of top-down control comes into play. Ever since he came into power, Xi has made it his life's work to consolidate. Anything that matters to China falls under his control, with the quote-unquote president taking a near-totalitarian approach to the country's economic policy. That clashes with China's traditional approach. Rather than using the collective decision-making that guided the country in the past, Xi has worked hard to concentrate power into his hands, essentially making the Chinese state and its ruling Communist Party one in the same. Just take his treatment of China's premier, the second highest-ranking official in China's governmental system, as an example. Before Xi took the reins, China's premier typically set the tone of the country's economic policy. That setup saw the premier consulting with a team of experts, with the quality of those experts ultimately determining the success of the policies the premier implemented. The president, for their part, was more of a figurehead in this realm. He'd relay the policies that the premier and his team developed while focusing on the bigger picture for China. That's not how it works anymore. Xi decided China's economic policy needed to shift when he came into power, bringing with it the ideas of stability and, quote, common prosperity. In short, he wanted to close the gap between the haves and the have-nots by creating a policy that gave more Chinese people a chance to gain a share of the wealth that the country generates. It's an admirable approach, but it's one that saw Xi quickly lose faith in his premier and the team of economic experts who informed policymaking before he came along. Unsatisfied with the answers they were giving to his questions, Xi wrested power away from them, becoming a team of one expert, answerable only to himself, on the issues of economic policy. The result, according to some experts, has been an almost anarchic economic environment within China that's often hidden by the official figures coming out of Beijing. Carsten Holz is one of those experts. He studies the Chinese economy as an expert at the Hong Kong University of Science and Technology, and he says that Xi's approach has made it extremely difficult to gain a clear picture of the economic reality in China. He points to issues like an over-indebted property sector and commercial banks' loans books of questionable quality, essentially painting a picture of a system that sees a lot of internal chaos even when it presents itself as one of the strongest in the world. Xi is at the center of all this. And a perfect example comes from his establishment of the National Financial Regulatory Administration, or NFRA. On the surface, the NFRA seems like a step in the right direction. Formed in March 2023 to replace the China Banking and Insurance Regulatory Commission, or CBIRC, the new body represents what CNN calls the biggest overhaul of the government in decades. The group will serve a similar purpose to the SEC in the United States, with some of its key responsibilities being to oversee investor and consumer rights in the financial sector while controlling the central bank. The problem? The NFRA represents the blurring of state and Communist Party lines we previously mentioned. Look into its leadership and you'll discover a man named Li Yunxi. Though he previously worked for China Construction Bank and the Industrial and Commercial Bank of China, Li ascended to the role of Deputy Governor of Sichuan in 2018. He's a Communist Party official. And being an official means that for all of its expertise, Li's actions are ultimately governed by Xi. The Financial Times put his approach in perspective, stating that the formation of the NFRA is really the latest indication of how Xi is seeking to govern through special CCP organs, over which he can more easily assert influence. Again, it's the top-down approach exemplified. The CBIRC certainly has its problems, particularly with corruption, but it was still a state entity rather than a Chinese Communist Party or a CCP one. With the NFRA, Xi demonstrates an outward desire to solve problems inherent to the CBIRC, while actually creating a replacement over which he can exert even more control than he already had. Clamping down on corruption and speculation is all well and good, but it comes at the cost of Xi strengthening his control over Beijing's financial sector. The message from Xi is clear: I know best. But the reality is there are plenty of issues in China that demonstrate the extent of his economic policy failure. Take the creation of China's new anti-espionage law as an example. On the surface, it doesn't seem like it should have anything to do with the economy. But that law sees Beijing raising questions about international businesses handling consulting work within the Chinese security sector, as well as business intelligence work conducted by investors. Not long after that law came into effect, China levied a $1.5 million fine against the American investment firm Mintz Group. The reason? Doing, quote, unapproved statistical work. That unapproved work would have been typical of any investment firm. The company needs to do its due diligence before choosing where to invest its money. But Xi has made it clear that foreign investors can essentially only work from the statistics that China provides for them, with the need for approval from Beijing allowing Xi to hide any economic issues that would cause an investor to be wary. It's all about control. The $1.5 million fine combined an administrative penalty for supposedly breaking the law with China claiming illegal proceeds from the Mintz Group. This could almost be seen as strong-arming the American firm. The raid was essentially a message to the other investment groups that any money they earn from China, especially if they try to take it out of China, could be at risk through the application of Xi's new anti-espionage rules. Like so many of Xi's policies, there's logic behind the policy. He believes that one of the causes of China's economic woes comes down to international investors taking money out of the Chinese economy. And he has a point. In the fourth quarter of 2023 alone, about $140 billion of long-term foreign investment left China, representing about 1% of the nation's GDP. Chatham House showcases why this is a problem, pointing out that just 10 years before, China had actually attracted an influx of foreign investment equivalent to 2% of GDP. It seems that Xi wants the money to keep flowing in, but is extremely hesitant to allow it to flow back out. Unfortunately, the approach of using anti-espionage laws to essentially claim money back from foreign investors will come back to bite him. Investors are now rattled. Rather than seeing China as a place where they can make money, which would encourage them to pump money into the economy, they now see it as a place where they could be punished for simply conducting the due diligence expected of them. As Xianggong Xu, a senior research scholar on China's economy and institutions at Stanford Center, says, it's a communist totalitarianism. The goal seems to be for the CCP to control everything, from China's regulatory bodies to its private firms, including foreign firms that have invested so heavily in the country for decades. Xu goes on to say that Xi's desire for control will likely result in a purge of many of those foreign firms, not because they don't add value to China, but because they won't allow themselves to be controlled at such an extent by the CCP. Xi is cutting off his nose to spite his face. By attempting to exert so much control, he's actively dissuading the foreign investors who've played such a huge part in making China an economic powerhouse in the 21st century. So China faces a future where foreign money won't be flowing in. Now let's shift our focus a little closer to home for Xi, the property market. For decades, China was practically dependent on its property market to fuel its economy. As long as the population kept growing, Chinese developers could rely on a near-constant influx of customers for their homes, and Beijing was more than happy to stoke the fires of that industry growth. After all, the property sector created construction jobs for millions, as well as tangible assets through which the country's middle class could store their ever-growing wealth. Even local governments loved the strong property market. They made a fortune from selling lands to developers. And that's all fine, until the real estate sector goes pop. This approach to real estate led to the average family having about 70% of their assets tied up in property, ultimately making those families dependent on the strength of the industry. When house prices went up, all was well. But when they started going down, it spelled pain for both the families and China's economy as a whole. The downturn started in 2021. According to Bloomberg, The 2 years between 2021 and 2023 saw existing home prices in over half of China's Tier 2 and Tier 3 cities drop by at least 15% from their peak. For context, every 5% decline in China's house prices represents a loss of 19 trillion yuan, approximately $2.7 trillion in housing wealth. So, 15% means just over $8 trillion gone in the blink of an eye. The culprit behind these massive losses? Xi's property sector policy. In truth, Xi Jinping inherited many of China's property woes. The sector had been the crutch upon which the Chinese economy leaned long before he came along, and he was happy to let it continue that way for several years after his ascension to president in 2013. But about 7 years later, Xi executed a crackdown on China's property development market, with that crackdown serving as his response to the debt being accumulated by the country's developers. Rewind to 2018 and you see a market in shambles. Bloomberg says that 2018 saw real estate account for nearly 20% of China's GDP. But at that same time, it only employed 2% of the country's workforce. And this wasn't glamorous employment. Most of the 16 million people who worked in the industry were migrants, spending long days at construction sites while getting paid a pittance for their efforts. They were essentially building houses they could never afford, with those on top becoming billionaires on the back of their hard work. The more cynical among you might say that that's essentially how capitalism works, but it's not conducive to a thriving economy. If the people in one of your most important industries are barely being paid enough to survive, how can you expect them to pump money into your country's economy? To his credit, Xi recognized rampant corruption, which he'd also allowed to continue, and decided to crack down. We see that in the investigation of Hui Kaiyan, the founder of China's Evergrande Group. In 2017, he became China's richest man. 3 years later, he was under investigation after China Evergrande Group defaulted on a huge number of dollar bonds. So Xi is cracking down on construction in development. Great, but it all came too late. Under Xi, property developers had spent the time between 2013 and 2020 creating what Bloomberg calls a pre-sales model. The idea was simple: sell apartments to customers up to 2 years in advance, allowing the developer to earn operating cash early in the process. Using that money, which came from wiring the prospective owner's down payment and their mortgage into an escrow account, the developer could get to work and deliver the home. The scheme incentivized developers to keep breaking ground, creating a constant stream of new houses that could counteract the rising property prices that were keeping many Chinese people out of homeownership. The scheme grew out of control. By 2020, Xi's crackdowns finally came into effect. Residential construction projects that were under construction accounted for about 10 times the actual amount of completed floor space. The crackdowns came, construction slowed, and now many of China's developers have simply run out of money to build the homes that they've essentially already sold to customers. By 2023, China found itself in a situation where there were 18 unfinished homes, most tied to pre-sales, for every completed property. What we have here is anarchy. Xi's early, some might call it lackadaisical approach to the property market allowed developers to run rampant. The average citizen was priced out while the middle and upper classes saw their assets skyrocket in value. Following the crackdowns, much of China is becoming a sort of development hell. The more affordable homes that were meant to be coming simply aren't being built. And in many areas of China, property prices are plummeting so fast that those who'd invested before are seeing huge portions of their family wealth wiped out. Bloomberg estimates that the correction of the market may affect over 5 million jobs. And it's easy to see why. With developers more hesitant than ever to break ground or finish projects they started, the poor migrant workers who relied on their construction jobs to survive may see China's most important industry wiped out from underneath them. And there are knock-on effects beyond that. Now racked with mountains of debt they're struggling to pay back, Chinese developers are missing their loan payments. For instance, Country Garden Holdings Company, previously one of China's biggest developers in terms of pure sales numbers, is in a $200 billion black hole, with half of the money relating to pre-sold properties. That's money that isn't going to be paid back anytime soon. So not only do the people who bought the homes that aren't being built going to suffer, but so will China's state-owned banks that are now tied into this debt through the mortgages they provided. Add to all of that the failed loan payments, and you have a financial sector that's going to struggle under the weight of loans it perhaps should never have made. Xi knows that China needs to reduce its reliance on property. His mantra has always been that housing is to be lived in, not speculated on. But the approach he's taken has created enormous problems for many in China, from regular citizens to developers, banks, and the country's middle class. Housing to be lived in is only effective when that housing is actually being built, and property is far from the only problem. China's manufacturing sector is also struggling massively, and its downfall happens to coincide with the years in which Xi has held power. In the year that Xi took power, China was the world's factory. Its manufacturing sector accounted for 31% of China's GDP, putting it ahead of even the property industry. But by 2020, the sector's contribution to GDP had dropped so significantly that it was only accounting for 26%. Even now, in 2023, it hovers around the 27% to 28% mark. What happened? Part of the issue comes down to other countries emerging as more attractive propositions for companies that need manufacturing. Vietnam and Mexico have emerged as major competitors to China in the years since Xi took power, snatching away some of the foreign investment into the sector from Beijing's clutches. But perhaps far more damaging, as well as being a contributing factor to other countries rising as manufacturing players, is Xi's Made in China 2025 initiative. Announced in May 2015, the goal of this policy was to have China shed its reputation as the world's factory. No longer would China be the byword for cheap and low-quality goods because it offered low labor costs to the rest of the world. Instead, China would focus on the innovation-driven production of much higher-value goods. Again, it seems like a logical policy on the surface. Yes, China would lose some foreign investment from companies that previously relied on it for low manufacturing costs, but Xi's policy would supposedly turn it into a manufacturing powerhouse, with Chinese goods making money for Chinese companies, propelling the country's economy in the process. We've already seen from the statistics that this didn't happen. Though many overseas saw this policy as an attempt by China to first catch up to and then move past Western technological prowess, the reality is that Made in China 2025 simply encouraged foreign investors into the country's manufacturing industry to look elsewhere. Just as Xi's anti-espionage laws from 2023 are warding off investors, so too is China's shift toward trying to position itself as a manufacturing innovator. In fact, the policy was so impactful overseas, it became the impetus for the trade war that marked much of Donald Trump's time as U.S. president. Xi's approach was to provide governmental subsidies to companies that he believed would be able to propel China's manufacturing sector forward. However, according to the Center for Economic Policy Research, or CEPR, Beijing has never made the list of companies that got the nod from Xi public. We know that some of the Chinese manufacturers are receiving subsidies from the CCP. We just don't know who or why. All of that information is controlled by Xi, again demonstrating how his top-down economic policy is causing problems for China. Instead of strengthening Chinese companies, Made in China 2025 sparked restrictions, tariffs, and export controls from many of its key trading partners. Xi responded with trade restrictions of his own, leading to the situation we see now. China isn't the manufacturing powerhouse it once was. So, we see how Xi's top-down approach has wreaked havoc on China's property and manufacturing sectors. We also see just how much he's doing to ward off foreign investment, making China more insular at a time when it could really do with attracting solid injections of overseas cash. But Xi's done more than alienate foreign investors and shatter China's property development sector. He had a terrible impact on the local level too. Prior to Xi implementing his 2020 property market crackdowns, regional governments generated about a third of their income from land sales. By 2022, the amount was closer to 10%, with ailing developers no longer able to afford the land that local governments wanted to sell to them. During that same time, local government responsibility for general expenditure reached 86%, a record high in the 42 years of statistics available from China's National Bureau of Statistics. This isn't all Xi's doing. Local government finances have been deteriorating since the 1994 introduction of the tax sharing system, which kickstarted China's economic burden falling more to local governments than national governments. At the time of the reform, local governments' collective share of China's revenue was a little over 75%. In 1994, that plummeted below 50% and had only just managed to crawl above that 50% barrier since Xi took charge. Not great when those same governments have to deal with 85% of Chinese expenditure, but Xi has done little to solve the problem. Yes, he cleaned up 12 trillion yuan, or about $1.67 billion of local government financing vehicles, or LGFV debt, during his first term as president, but by 2022, liabilities related to LGFVs had rocketed up to 57 trillion yuan, or about $7.92 trillion. That's 48% of China's GDP, almost level with the national borrowing, and it's one of the main reasons that China's debt-to-GDP ratio has risen to 360%, compared to the 200% it was when Xi took over. And now, by taking away land as a means to generate income for local governments, Xi's created a system that will see many of its cities, especially its smaller ones, doomed to fail. There's a saying in China, those in Beijing hold the purse strings, while local cadres hold dirty shovels. The implication is that while all of the smaller cities and towns do the dirty work, Beijing rakes in the money and ultimately controls how much of the money those smaller locales receive. Xi might not have created the policy, but he has perpetuated it, much to the detriment of local government finances. And all of this is in service of creating a stronger China in which the wealth inequality gap is shortened. But even that noble ambition isn't coming to pass. Though Xi goes to great lengths to talk about how his policies are designed to prevent wealth inequality, the fact is that China's elite are richer than its low and middle income households than ever before. The top 20% of the country's urban households earn 6.3 times more than the bottom 20%, the highest gap since 1985. All of this means that China has a cavalcade of problems. Its economic growth is unimpressive when taken into context with its GDP expenditure. The property market is in shambles, with the manufacturing sector also struggling. And given that these are China's two most important industries, it should come as no surprise then that youth unemployment is high, according to the BBC. And all of this has knock-on effects for the rest of the world. Due to all of Xi's failed policies, China's consumer market is weakening. That's bad news for the global companies that sell to Chinese consumers, such as Apple, because that means they're receiving less revenue from China. Less money to those major multinationals results in lower demand for supplies, affecting thousands of companies within the supply chains of those major hitters. So Xi's failures don't just lead to unemployment and economic woes in China. They cause the same issues for many of the foreign businesses that have relied for so long on Chinese consumers propping up their record profits. The question now is simple. Is there a light at the end of the economic tunnel for Xi Jinping? One positive he can take from all of this is that household deposits in China exceeded the country's GDP. That's a symptom of the stock market crash of 2015, which occurred during Xi's stint, leading to more Chinese people choosing to save rather than invest. These savings give the state-owned banks a cheap source of money, which they can then use to provide loans to high-end manufacturing companies. And it's certainly the case that loans to these types of companies, which are intended to be the beneficiaries of Xi's Made in China 2025 policy, have skyrocketed. But can one small win mean much when measured against the devastation wrought elsewhere? Perhaps Xi is the only man who has the answer. After all, he seems to believe he has the answers to everything in China. Still, what do you think? Are worries about China's economic woes overblown? Perhaps you believe Xi has some sort of master plan he's waiting to unleash. Or are we simply watching a totalitarian ruler who's allowing his country's people and financial institutions to be placed under immense stress, all in service of his political party gaining more control? Tell us what you think in the comments below. Now watch what would happen if China and the US went to war hour by hour, or check out this video instead.